Welcome to the Deep Dive. Today, we're jumping into a really fundamental topic,
Uh-huh.
investing. And specifically, we're looking at it through the lens of, well, common sense,
Mm.
based on the insights from the little book of common sense investing.
It's a great source. Really cuts through the noise.
Exactly. Our mission here is to unpack the core ideas from this book, sort of give you a shortcut to understanding what really matters for building wealth long term. The book's full of powerful arithmetic, some uh, genuinely surprising facts, too.
Yeah, it lays out the mathematical realities very clearly,
Yeah.
sometimes brutally clearly.
Okay, so let's get right into it. Where does the book say we should start? What's the basic building block of this whole approach?
Right, the foundation, it really comes down to the index fund.
An index fund. What exactly is that, according to the book?
Well, the beauty is its simplicity. The book just calls it a basket portfolio. Basically, it holds a whole bunch of securities, could be stocks, bonds, whatever, and the goal is just to mimic the overall performance of a market or a market sector.
So it's not about hunting for the next big thing.
Not at all. The classic index funds, the ones the book really focuses on, they hold the entire market basket. And by doing that, you automatically sidestep a bunch of risks. You know, the risk of picking the wrong stock or betting on the wrong industry.
Or even picking a fund manager who just doesn't perform.
Exactly. You're mainly left with just the basic stock market risk, which, as the book says, is quite large enough, thank you.
Okay, the book does mention index funds might seem maybe a bit dull compared to active trading,
Yeah, they lack the excitement factor for sure.
but it also highlights their truly remarkable long-term productivity. How does that work? How does being kind of boring lead to good results?
Well, that's the simple brilliance of it. An index fund basically guarantees you capture your fair share of whatever returns businesses collectively earn. Think about it this way. The fund essentially owns corporate America. It buys every stock based on its size in the market.
It's market cap, right?
Right, it's market capitalization. And then this is key, it just holds it, basically forever.
Holds it forever. That feels counterintuitive. Everything you hear is about timing, buying low, selling high.
I know, right? But that do-nothing approach is exactly why it works so well, because it just holds the market, it operates with incredibly minimal expenses, no real advisory fees, tiny portfolio turnover.
Which means lower trading costs and better tax efficiency.
Exactly, high tax efficiency. These super low costs are absolutely fundamental. It's their biggest edge.
Okay, that makes sense. If owning businesses earns returns, and index funds do that cheaply,
Yeah.
why does the book say the typical investor actually lags the market? By quite a bit, apparently, like 2.5 percentage points a year, according to one study.
Ah, yes. This is where we hit the core problem. The book calls it the relentless rules of humble arithmetic.
Humble arithmetic. Sounds ominous.
Well, the math itself is simple. All investors, as a group, must earn the market's return before costs. Collectively, we are all average.
Okay, before costs, everyone together gets the market return. Makes sense.
But here's the kicker, the really critical insight. Each extra return that one of us earns means that another of our fellow investors suffers a return shortfall of precisely the same dimension. Before costs are factored in, it's basically a zero-sum game. For me to
Yeah.
win, someone else has to lose, relatively speaking.
So if my genius stock pick doubles, somewhere out there, another investor's holdings are underperforming by that same amount relative to the average.
That's the idea, before costs. But then the costs come in. The book points to the croupiers of the financial markets, the financial industry itself. They take their cut.
The house always wins.
Sort of. You have to subtract all the costs of financial intermediation. That's, all the management fees, commissions, sales loads, fund operating expenses, trading costs.
All the little bites out of the apple.
Exactly. And after you subtract all that, investors as a group absolutely must and will and do fall short of the market return. The value gets skimmed off the top.
And the book gives some numbers on these costs, right? They're not insignificant.
No, not at all. For direct investors trading stocks themselves, the book estimates trading costs can average maybe 1.5% a year, higher if you're really active.
And for mutual funds.
It's often layered. You've got the expense ratio, maybe 1.5% on average for active funds, then maybe a sales charge, say 0.5%. But then there's the hidden cost, portfolio turnover, funds buying and selling all the time rack up costs. The book figures that alone can easily add another 1% per year for the average active fund.
Wow. Okay, so let's add that up. 1.5% expense, 0.5% sales charge, 1% turnover. That's like 3%, maybe even 3.5% a year.
That's the kind of ballpark figure the book suggests for many actively managed funds. It's a huge drag.
And crucially, you pay those costs whether our returns are positive or negative.
Absolutely. Win or lose on the investment, the fees still come out. So this simple math leads to a really key conclusion in the book. Beating the market before costs is a zero-sum game, right? But beating the market after costs is a loser's game.
A loser's game.
Yeah,
Because the costs guarantee the average investor underperforms the market.
precisely. For the group as a whole, it's a mathematical certainty.
And the book illustrates the long-term impact, doesn't it? The tyranny of compounding costs.
Oh yeah, it's a powerful example. Imagine you invest $10,000. Let's say the market historically returns 8% a year. Over 50 years, that $10 grows to roughly $469,000.
Okay, pretty good.
But now, put that $10K in a fund with typical costs, say 2.5% per year. Your net return is only 5.5%. After 50 years, that same $10,000 grows to only about $194,000.
Whoa, hold on. 469K versus 194K, that's over $270,000 less. Just gone to cost.
Exactly. It makes it incredibly clear. Costs aren't just a minor detail. The book says they play the determinative role. They are the biggest factor in your final outcome.
That is staggering. Okay, this connects to another point the book raises, this idea of the grand illusion. It says the returns funds report aren't necessarily what investors actually earn. Why the gap?
Yeah, this is super important and often missed. Funds usually report time-weighted returns. That shows how the fund's assets performed, assuming the money just sat there. But your return as an investor is dollar-weighted. It depends heavily on when you put money in and when you take it out.
And people tend to be bad at timing that, right?
Terribly bad, unfortunately. We tend to chase performance, pile into a fund after it's had a great run.
Buying high.
Right. And then panic and sell after the market drops.
Selling low. A classic mistake.
Exactly. The book cites some shocking data. Over 25 years, the S&P 500 index fund returned about 12.3% annually. The average equity fund reported 10%, not bad, but the average investor in those funds, they only earned 7.3% annually.
Wait, 7.3%? That's nearly 3 percentage points less than their own fund reported.
It's huge, a 2.7 percentage point lag below the fund's own number. It's not just lagging the market. Investors are lagging their own investments because of poor timing.
Driven by counterproductive market timing and fund selection, as the book puts it.
Precisely. It really highlights the impact of emotion.
Ah, yes. The book mentions the 4 E's.
It does, and it boils it down to this. The two greatest enemies of the equity investor are expenses and emotions. And what's powerful is how the book's solution indexing tackles both. By minimizing expenses, you also create a structure that helps you manage emotions by simplifying things and reducing the urge to constantly tinker.
Okay, so we've established the problems. Costs are a mathematical drag, and emotions lead to bad timing. What does the book propose as the winning formula? This solution.
It all comes back to what the book calls the majesty of simplicity. The winning strategy, based on all this evidence and math, is straightforward. Invest in a low-cost index fund that owns the entire market and then hold it forever.
Hold it forever, just keep holding.
That simple approach guarantees you get your fair share of whatever businesses earn over the long run.
It almost sounds too easy, with everyone pushing complex strategies.
I know, but the advantage is rooted in that cost difference we talked about. Index funds have rock-bottom costs, expense ratios under 0.2%, sometimes way less, minimal turnover costs. Compared to that 3.5% drag we estimated for active funds, it's a massive head start. Costs are predictable, performance isn't.
It reminds me of that quote the book uses from Cervantes. Picking winning funds is like looking for a needle in the haystack.
Exactly. And Jack Bogle, the founder of Vanguard and champion of indexing, added the perfect corollary: don't look for the needle in the haystack, just buy the haystack.
Buy the haystack, I like that.
Indexing is buying the haystack. You just sidestep that whole almost impossible game of trying to find the few managers who might beat the market after their fees.
And lots of big names in finance agree with this, according to the book.
Oh yeah, the endorsements are powerful. Warren Buffett says it's the best approach for the know-nothing investor who can actually beat most pros this way. Charlie Munger calls the costs of active management disgusting. William Bernstein advises just avoid the problem by a well-run index fund. Even active traders like Jim Cramer have apparently considered joining the index camp. Clifford Asness calls indexing the deserved king of the investment world.
That's quite a consensus from people who know the industry inside out. The book even ties it back to Benjamin Graham.
It does. Graham preached diversification and long-term holding core index principles. And later in life, Graham himself admitted that consistently beating the market was much harder than he'd thought. He basically suggested aiming for market returns minus minimal costs was a very sound approach.
So the winning formula is buy the market cheap, hold on tight. But how do you actually do that? How do you stay disciplined when markets are going crazy?
The book's advice is pretty blunt. Investing and then dropping out of the game.
Drop out. Like, stop paying attention.
Essentially, yes, with your core strategy. Adopt a mindset of do nothing, just stay the course. Set up your index fund investments and let them be. The danger comes from all the distractions that tempt you back into action. Chasing hot sectors, trying to time things, even misusing newer tools like ETFs.
Wait, ETFs can be bad. I thought they were low-cost index tools.
They can be. An ETF that tracks a broad index and that you just buy and hold is perfectly aligned with the strategy. Low cost, diversified. But the book implicitly warns, handle with care. Because ETFs trade like stocks, the temptation is to trade them frequently. And once you start doing that,
You're right back to paying commissions, maybe generating taxes, and likely timing things poorly based on emotion.
exactly, you've reintroduced the costs and the emotional decision-making that indexing is designed to eliminate.
So the tool itself can be good, but how you use it matters.
Absolutely. The book makes a really useful distinction here, talking about serious money versus funny money. Your serious money, the core savings for retirement, for big goals that belongs in the simple, low-cost buy and hold index strategy. Your funny money, if you absolutely feel the need to speculate or trade, should be a very small, separate pot that you can afford to lose.
And the book predicts the serious money will massively outperform the funny money over time.
In a landslide, yes, the math is just relentless.
And that math becomes even more important if future market returns are lower than in the past. Right?
That's a critical point the book makes. If overall market returns are lower, say 6% instead of 10%, then fees of 2–3% eat up a much bigger chunk of your potential gains. Minimizing costs becomes even more vital.
Okay, so let's try to wrap this up. What's the ultimate message from this deep dive into the little book of common sense investing?
I think the absolute core message is that this isn't about guru predictions or complex theories. The success of indexing rests purely on mathematical facts. It's those relentless rules of humble arithmetic. It works because it strips away layers of cost and helps you avoid the emotional mistakes that sink most investors.
Simple but powerful.
Incredibly powerful. The book quotes Nobel laureate Paul Samuelson, calling the invention of the first index fund the equivalent of the invention of the wheel and the alphabet for investors.
High praise indeed.
It is. And while the book doesn't claim indexing is magically the best strategy for every single person in every situation, it argues convincingly that the number of investment strategies that are worse is infinite. The low-cost, broad market index fund is the standard because it delivers the market's return with near certainty minus minimal cost. It's simple, it's effective, the math works.
A really clear and compelling case based on decades of evidence and simple arithmetic. Buy the market, keep costs incredibly low, and stay disciplined for the long haul. That seems to be the essence.
That's it. And maybe here's a final thought to leave you with, something the book makes you wonder. If the math is this clear, the logic this simple, and the evidence this overwhelming, why do so many people and so much of the financial industry still push for complexity, higher costs, and strategies that demonstrably underperform for most investors over time? What does that persistence tell us?
Definitely food for thought. Well, this has been incredibly insightful. Thanks for walking us through it. Don't forget to subscribe to the Next Thought podcast.